Or to the cloud. All right, what's up, guys? Jake Ryan here from the NBA MW. I got my good friend James Baublitz from First Home Mortgage has joined us today. James, thank you so much for joining us on the Keys to the Market podcast. We appreciate it.
Absolutely. Thanks for the invitation. Happy to be here.
Awesome, man. Well, I would love for you to give us a little bit of background on you. How'd you get in the industry? Where have you worked? And kind of catch us up to speed on how you got to where you are today.
Sure. Yeah, absolutely. Well, let's see. I've been in capital markets in various shapes and sizes for about 20 years at this point, which is crazy to say. I started out on an equity market making desk, which is a fancy way of saying I was helping to trade stocks, specifically in the banking sector. Then in 2012, I made a geographic move to the DC area, specifically Baltimore, and I left to join a company called Compass Analytics, which is now owned by Optimal Blue, the pricing engine. And Compass is basically the software that secondary folks like myself use to run their daily operations. So I eventually became one of the partners in the firm, and I was there for about a little under 10 years. And I left in 2021, right before rates started backing up, to join First Home, where, as you mentioned, I currently head up our capital markets team. So that includes a few things, primarily our daily risk management and the products that we offer, and then our post-closing group. And finally, these days, when I'm not doing my day job, I'm also involved as an instructor with Panoramic Capital Academy, which is the industry's only provider of advanced secondary marketing education. So when I'm not doing the job, I try my best to teach it to others.
There you go. Spreading the good word.
I
I,
try. I try.
I love it. So James, obviously that we're now, as we're filming this is April 7th. Things are definitely interesting, but I feel like they're always interesting in the world. But kind of catch us up to speed on where we are in today's rate environment and a very brief background of how we got there.
Yeah, how long do we have, right? Well, let's see. I'll try to do this quickly. So during the pandemic, policymakers pushed interest rates to about as low as they've ever been. And so when the dust cleared and the economy reopened, there was a bout of inflation. And by that, I mean the rate at which prices change month over month, year over year, et cetera. Investors and market participants saw this, and interest rates went a lot higher, the highest they'd been in years. So the Federal Reserve was basically trying to slow down the economy to fight inflation. So in a mortgage context, as I'm guessing everyone on this podcast is very aware, 30-year fixed rates went from something like 2 3/4 to something like 7 3/4 in a couple year period. So fast forward, inflation started to cool down through a series of different actions, and so interest rates started to drift a little bit lower, something like the high fives, low sixes. But to bring it kind of to current day, just as we started to see a little bit of a light at the end of the tunnel, or at least that's how I felt, the conflict in Iran began, and the oil market, as we're recording this right now, is through the roof to levels we haven't seen in years. And so this is basically bringing the concern that inflation is going to edge higher again. And when inflation goes higher, rates typically go higher too. So today we have a whole host of moving parts. Will the economy continue to grow? Will inflation get down to a lower number? Will the war end? What's going on with tariff policy, right? You name it.
Sure.
The end result for us in the mortgage sector is that interest rates have remained a little higher than we'd like to see. And at present, there's a number of kind of competing priorities that are keeping us there.
I appreciate that. So you mentioned inflation in there, which is obviously very important to originators everywhere. What is the quickest and simplest way you'd explain why inflation is bad for mortgage rates?
Yeah. So inflation, so basically you need to think the best way I could explain it is this. Uh, Whenever you are thinking about what's going on in the market, it's helpful to put yourself in the shoes of an investor. So if you're an investor, if you're a money manager, if you're putting money to work yourself, right, you're trying to earn some kind of a rate of return. And you can invest in stocks, you can invest in bonds, you can invest in real estate, et cetera. But, at the end of the year, you're trying to earn, pick a number, 10%, 5%, 4%, whatever it happens to be, right? Hopefully more. Inflation erodes that. If you earn 10%, but inflation was 9%, the purchasing power of your investment really only increased, 1%, if you will, right? So when inflation moves higher, when you have something like a fixed rate of return, like a mortgage or any other kind of bond for that matter, it really directly erodes that purchasing power. Because again, you're not buying typically a 1 year bond. I mean, you can, but when you
Mhm.
think about a mortgage, for example, we're typically talking about something that's like a 30-year fixed rate mortgage. So the higher inflation goes, the more your purchasing power erodes, the less attractive that bond ultimately is to purchase. So it's one of the big things that drives interest rate policy as a whole. And so we've been in a period of higher inflation, and that's sparked a lot of the price action in the market as a whole.
Okay. I mean, certainly makes sense. So we talked about kind of where we are. And in the very short term, things were looking really good end of February. Then I think it was like that last weekend of February, bombs start going off, things start changing, right? So you touched on the oil markets briefly, but traditionally, when we think geopolitical tension, conflict, there's usually the term we've discussed is flight to safety, right? Walk us through why that didn't happen this time around.
Well, there's two real reasons. You're exactly right. So for most of our collective adult lifetimes, whenever things start going wrong around the world, and again, just focusing on the financial implications, typically what we start to see is we see rates go lower. That's just one of the kind of classic things. Uh, the reason that didn't happen this time around is really kind of twofold. The first is that whatever flight to quality bid you want to see, whatever impetus you might see, oh, everything's going wrong, let me go buy treasuries and lower rates. Uh, it was kind of offset by whatever's going to happen in the oil market. The it's not quite a doomsday scenario, but one of the things that people have been nervous about for a very long time is what would happen if the Strait of Hormuz actually closed, and that's what we're seeing right now. So we're seeing the kind of oil inflation, and we see that, of course, impact us at the pump in terms of gas prices, but it also has implications for the cost of goods generally. So the oil prices going up really then exacerbated the existing inflation concerns we already had, and had a pretty dramatic impact as a result on rates. So short answer to the first point I would just say is that the oil market kind of overshadowed whatever that flight to quality bid might have been, flight to safety
Sure.
bid. And then the second thing is, again, just whatever your view of politics are, whatever you think about everything that's going on in the world today, it's also, I think, at least a little bit the case that the U.S. is maybe a little less predictable than we used to be. I think that's probably fair to say.
Yeah, yeah,
And
you could
so
say
with
that.
that in mind, the traditional, okay, let me just put my money in something ultra safe like a U.S. Treasury. It's a little bit hard to say that when the US was the one that maybe instigated the action in this particular case, the US is also the safest place to be as well. So
Sure.
I think that's still the case, right? But I think on the margins, that probably didn't help either.
So it's been funny the last couple of weeks, I've been talking to clients, and I would say, the good news is it seems like between Liberation Day and this conflict in Iran, we've been getting ourselves into these issues, but in theory, we could get ourselves out of these issues too,
Right.
right? So, it seems like although these issues are self-inflicted, which one would believe the positive is, you're able to hopefully end it and resolve it. So when we think about, I mean, because Liberation Day, I mean, that was what, like about a year ago this time, I want to say.
Yep.
And for those not familiar, right, the tariff changes, big, it was kind of the big chart and like, reciprocal action. It was kind of interesting. Didn't really pan out exactly as they explained. But the point of that is, huge spike, 10-year went crazy. Rates went up, but then we kind of saw rates kind of fall down all through 25. Um, so we talked about where we're at now. What's your kind of crystal ball on short term, long term? Where do you see going from here? And then obviously everyone's going to hold you to this, and if rates go up, they're going to
Exactly.
be upset.
Just reported, right?
Yeah,
Yeah. Well, I think the thing that's so unique about 2026 and I guess 25 for that matter too is there are so many geopolitical issues going on right now, and you just mentioned a few of them. But again, to focus just on the financial impacts, it's hard to speculate when you look at that crystal ball because right now we don't have a great deal of visibility into what's going to happen with the war. Is it going to continue to be a slog, or to your point, are we going to see the U.S. Basically pull out? That's the
hmm
current driver, a lot of this volatility. If we could somehow snap our fingers and come to a peace agreement, then presumably the oil market would begin to normalize and markets would return to normalcy too. And we would start to,
Sure.
again, all else equal, probably rates starting to decline a little bit with that in mind. If that doesn't happen, let's say it's just difficult for the US to extricate themselves from Iran, then just focusing again on the oil market becomes less about the short-term shock and the bout of inflation in time for, say, summer driving season, for example, and more
Hmm.
about the long-term impacts to economic growth. And that makes things more complicated because, again, like you have all this happening all at once. So
Sure.
you have the conflicting signals. You have the oil market on one hand and tariff policy on another. You have lack of clarity on inflation on still a third, right? And so I think that's really the net I would emphasize is this lack of clarity. There's such a host of unknowns right now that are complicating things for policymakers that when this happens, market volatility increases and volatility isn't good for mortgage rates, to put it simply. So what I would say, kind of in general, is that most economists that I follow think we're going to be in this general rate range for a little while, plus or minus, call it 0.5%. We might edge a little higher, we might be a little lower, but we're probably going to be in this ballpark until things calm down. So that's kind of my guess at this point. Is certainly we're not going back to 2% mortgages anytime soon. Certainly, I don't see 8% mortgages anytime soon. I think we're probably going to be somewhere in this general ballpark for a while.
Okay. I mean, that's good to hear. Obviously there was a couple weeks where things are getting worse very quickly. It was reminiscent of what was it, 23 when rates hit 8%. I want to say that wasn't very fun. That was a lot of golfing that fall, I believe. Um, all right, so we talked about some possible outcomes here. And earlier we touched on the 10-year, right? For those that are new to the industry or just not very well informed in the secondary capital market side, explain a little bit more about the 10-year and why that's so important in regards to mortgage rates and why we care as originators. What's going on with the 10-year?
It's a really good question. So let's use that same experiment that I started with a while ago. Let's pretend that we're an investor, or again, better,
Okay.
new manager. You've got something like, you're personally in charge of investing $100 million, right? So your goal is to earn a rate of return. And so the question is, how would you do that? So you could certainly invest in stocks, or you could invest in real estate, or you could invest in bonds, and a number of other things. Well, bonds are basically loans, and so they pay a fixed rate of return, but they don't usually offer as much upside as investing in something like a stock. So it's more of a conservative bet. Now, the risk for a bond is that the counterparty, whoever you're lending money to, doesn't pay you back, right? They go out of business. Uh,
Hmm.
the good, bad, otherwise, the 10-year Treasury note and anything that's backed by the U.S. is considered to be completely risk-free. And again, it's maybe a little hard to believe sometimes, but it's a core principle of how markets work. That the idea that the U.S. government will never default. I don't care what our debt is; it's completely risk-free. So if you're an investor and you want to invest in bonds, you can always say, all right, you know what? I can always invest in something that's completely stable, completely risk-free. It might not make me retire tomorrow, but I can always invest in a treasury, right? So with
Sure.
that in mind, we think of it as a quote unquote benchmark. Okay. So bringing it to mortgages, that means that the money manager can always invest in that risk-free bond, right? Or they can invest in something a little bit riskier, like a corporate bond, so a bond to an individual corporation, or something, again, a little riskier, like a mortgage-backed security. That's our space. So each
Hmm.
of them offers a little bit of a higher rate of return than a treasury because there's more risk and nuance involved. But at each point, the thing that I would emphasize here, the money manager is comparing that potential return and that potential risk to something of a risk-free investment in a treasury bond. So that's a long way of saying it serves as kind of a reference point. And so
Like a benchmark of sorts.
exactly, when we look at what's going on in the market, we always do that relative to some kind of a reference.
Okay. And when I hear people talk about the spread,
Yeah.
right? Give us a quick synopsis of that when we're looking at the historical spreads versus current spreads. How should we interpret that?
So the spreads for each of these different things, it really comes down to how much risk is in the system, I guess is probably what I would put it. That the question is, okay, if the 10-year is paying a coupon of 4% and the a new production mortgage is paying 5.5%, the spread that we would then talk about is something like 150 basis points or 1.5%. So sometimes that spread tightens a little bit, and maybe in the same market you can get that new production mortgage for 5.25, and sometimes it widens to say like 5.75, for example. So when we think about the overall rate environment and what's going on, one of the things we look at is what the level of those spreads are and what is influencing that. And that has a whole host of things that are probably beyond the scope that go into it. But things like how much demand there is in the system for mortgages and some policy considerations will like go into it too. So it's a really good thing to kind of track, and it varies based on what's going on in the world.
Okay, that's good. You just touched on coupons.
Yes.
Okay. I am a simple loan originator, right? I go out and talk to clients. I'll get them to apply. We close loan. After they close, a whole host of things happen, right? And I know that we are hearing about coupons, and we're on a 5% versus 5.5. Can you give us, for the layperson, what are coupons? What do I need to know? What can change? What's going on here?
Yeah, so whenever we're talking about a bond, we always talk about what's called the coupon, which is the fixed rate of payment that it pays. It comes back from the old days where you literally would clip a coupon and send it in and get money in exchange. So what I would say is loan officers, in my view, should know enough to be dangerous here because MBS coupons are the basis of how their rates are ultimately created. So the business of a lender at its simplest form is to take applications and make loans, and ultimately to sell that loan to a third party. That's what most modern lenders are doing today. They take the loan, they sell it. They may or may not retain the right to service that loan for anyone familiar, but
Mhm.
generally speaking, that loan is sold to a third party so they can get their money back and take that next loan. Okay. So to your point, different note rate to the borrower now, can be delivered into different MBS coupons. So that five, the 5.5, and so on, right? And these coupons are traded in 0.5% increments. So again, like a 4, a 4.5, a 5, right? Not a 4, 5.25, right? But everything 50 basis point steps.
Mhm.
And that just is to basically promote the market in general. Again, I'll spare you all the details of that. Different, I guess the thing that I would say about the end of, and the ultimate coupons is maybe the most germane thing for an originator is that different coupons are going to increase and decrease in value at different rates. Meaning, if the 10-year, for example, increases in value, one MBS coupon might increase more or less than another, right? So I think, at least, it's important for a savvy loan officer to understand the basics because, that all, I guess, MBS coupons aren't created equal, for lack of a better phrase, because the potential price movement of a higher note rate, let's say investment property, is going to differ from the lower note rate, let's call it a refi with perfect credit, again, just as an example. So by understanding some of these different dynamics, loan officers can better set expectations and advise their clients about the potential risk of what they're seeing in the system. How did it
You
do?
still, that was great. I would say your video froze though.
Oh,
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 there you go. Okay, you're gonna laugh because it was a very funny face you were making. Um, that was a great explanation. The one thing I would love is, and we've talked about this before, what is a range of a coupon, right? So let's use like 5.5. What rates can go into that coupon?
it's a good question. It's going to depend on if we're talking about a conventional or a government loan. So
Let's
ignore.
assume conventional for this conversation.
So a conventional loan is going to be as low in the case of a 5.5% coupon. It'll be as low as a 5 3/4 note rate, all the way
Okay.
up to something like a 6 5/8 note rate. So anything
Okay.
that can go into a 5.5.
Gotcha. Okay. Um, and is this kind of why? So there is some overlap, I'm imagining, correct?
That's correct. Yes. So coupon individual note rates, again, just focusing on conventional, can go into two coupons. So you can deliver into a high coupon or into a low coupon for each note rate.
So is this why sometimes we'll see advantageous pricing, especially like the eighths, right? The eighths and the 5/8, like we'll tend to see.
Exactly right. And again, this all goes into the guts of how a loan is valued, but you have
Mhm.
it exactly. Sometimes we see really counterintuitive things on our rate sheets where one particular note rate sticks out like a sore thumb, and you have
Sure.
a drop between note rate A and note rate B. And that's it exactly. It has to do with how the loans are being valued into two individual coupons.
I mean, I've been doing this like 13 years now, and I don't remember if it was just me not paying attention when I was earlier in my career, but I always had this basic mindset of every eighth and rate was a half point, right? And sometimes you see that, but now I don't know if it's just since COVID, I've noticed it more. There are these, narrower segments of the rate sheet,
Yep.
right? Where an eighth could buy you an extra eighth in rate, a quarter would buy you an extra rate. And I tell myself and all the loan officers in my group, it's like you have to look at the whole rate stack, right? The market is telling you where they want you, right? There are advantages to doing certain note rates, and if you're going to pay a little bit in points or this or that, the age of defaulting to a 0 point quote is not what your competition is always going to do.
100%. And to your point, I mean, look, none of us like to pay points, right? But
Sure.
at the same time, there are certainly situations where that extra 50 basis points, 100 basis points can make a really, really big difference. And I would emphasize what you just said and say the likelihood it's not going to change anytime soon for a variety of reasons, but mostly because loan sizes have gotten so big. And
Mm-hmm.
again, I'll spare the details for why, but the key point is that loan sizes have gotten big. The cost to insure a loan, and by that I mean from Fannie and Freddie, what we call our guarantee fee, has increased.
Sure.
And it's just made a lot of a lot of those MBS coupons trade at similar dollar prices. I would say that the coupon stack is compressed, to kind of rephrase it like that. And so, with that in mind, it exacerbates everything you're talking about. Couldn't have said it better.
I love it. Well, I learned it from you, right? That's why. Uh, so look, let's say I'm new, I'm first couple years in the business, whatever, and I want to learn, right? And I want to get better. I want to advise my clients. What's the best way you'd recommend for those that are interested in learning more about secondary markets, the economy? How would you recommend they get started?
Well, I mean, since you're giving me the opportunity, I'll give a shameless plug
Of course, it's a
for
layup.
anyone that wants to master their craft. Look into Panoramic Capital Academy. We offer an 8-week course and a 14-week course that is specific to mortgage banking and secondary marketing, which is, again, hard to find. It's a very niche kind of thing. So if you're very serious about it, that's always a great option. If that's a little too much of a time commitment, what I would say to get started is I'd suggest a couple things. So the first is read financial websites, things like the CNBCs or Bloomberg's or Wall Street Journals of the world. And and I would just encourage someone, especially if you're just getting started, to really read the articles. We all just skim things. I certainly do all the time, but it helps to develop the muscle memory of how financial markets work. And to me, that pays a pretty large dividend, in my opinion.
Sure.
There's less secondary marketing specific content out there, because it's a very small niche. There's only, couple hundred, a couple thousand of us out there,
Yeah.
But for
You're endangered species.
what I would also tell you is that your capital markets guy or gal is also very likely quite happy to talk to you about their job too. There's a number of different perspectives and strategies and so on from different lenders, but like anything, we're always certainly pretty happy to talk about our jobs too. So read the basics, get the basics of markets and how things work, and be able to explain that pretty well. And then, at that point, like I said, I would encourage you to reach out to your secondary team too.
I love that. To piggyback on that, I would also encourage people, if you're not signed up for the Rob Christman newsletter, I think he's very good. You do the what every month? You do
Yes.
a video with him.
I do, yeah. So I couldn't agree more. Rob Christman is great. I've known him for years. I joined his podcast to talk about these very topics once a month with a couple of my colleagues and friends. But yes, Rob is fantastic. He's an old secondary guy. He always gives a market update, but it's also just I read it every day. It's one of the best ways to stay
Yeah.
current with the market as a whole, the industry as a whole, I should say.
I every day I start my day with that and Bloomberg, and I tell you, it's I really just skim the top part and
Yep.
then go through the capital markets part is what I really look forward to the bottom. I feel like that just gives me enough ammo to start the day if any conversation comes up. Um, Also, for those that don't know, like I always explain this as there are known unknowns and unknown unknowns, right? Like when there's going to be reports released,
Yep.
right? Which economic reports do you kind of pencil on the calendars? Like, all right, we got to really pay attention to these things.
It certainly depends on the rate environment and what's going on, but generally speaking, anything that's a non-farm payroll, so what's going on with the unemployment rate, how many jobs were created this month. These days, inflation reports, both the Fed's favorite, which is PCE inflation, as well as the CPI inflation, tend to be really big, and GDP reports too. Those are probably the big three, I would say.
Okay, so we'll role play here. Let's say James is the loan officer, and let's
Ooh,
say Jake is the client, right?
yep.
How would you explain that? Why the non-farm payroll matters so much? Why does employment matter so much when it comes to mortgage rates?
So what I would say is that mortgage rates in general and interest rates as a whole really are based on long-term projections of inflation for kind of those reasons that we were talking about earlier. There's other
Okay.
things that go into that, but that's one of the biggest things. Um, when those are key things that ultimately influence the rate of inflation in the country. They influence things like the what the Federal Reserve is going to do. They influence things like what overall all the bond investors, all the market investors are looking at these things because they're projecting out what the future is going to look like in terms of interest rate paths. So those are new pieces of information, is what I would say. They're
Okay.
new pieces of information that we might have been modeling, but we hadn't seen the real information or the real data yet. And so when
Sure.
things happen that I'm expecting X, but I end up getting Y, then all of a sudden what ends up happening is I have to change my assumptions. I have to change my inputs. And that's going to make me, or better yet, my traders, buy and sell something. So those represent changes to the future, and the future is really what is based on a market of what markets are based on. I would just say one last thing on that point, which is we've all heard the same, radio report or seen the same headline, which is something to the effect of, XYZ company reports record earnings, record sales, stock down
Yeah.
30%, right? Because it doesn't matter what they did this quarter, it remembers what they said is going to happen in the future, right?
Yep.
That's what we really care about, And so again, it's the same thing with respect to interest rate policy too, that when we get these new pieces of information, what does that mean ultimately for the future?
Well, I mean, that's such an easy layup to talk about every time the Fed cut. And we'd have clients talk about, oh, I saw the Fed cut, so it must mean rates are coming down. And to your point, it didn't matter. It was all about the press conference. Like you could literally watch the charts for the coupons, and then all of a sudden, right, you'd see the big drop when he says, I don't know, we're going to be, data dependent, blah, 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 blah. Like it's really about what they say, not about what they've done.
Exactly. Couldn't agree more. It's if you know it and I know it and the market knows it that this is going to happen, it doesn't matter. It's already been, as we would refer to it, it's already been quote unquote priced in. What we
Correct.
do care about is the new information. We knew what was going to happen here. We knew what he was going to say there. Oh, I didn't anticipate this. Hold on. That's the thing that I'm going to react to.
Yeah. I mean, and really, it feels like, you know, I've always heard this. I think it was Mike Farrell, who I used to work with a long time ago, would always talk of this adage of rates rise like a rocket and fall like a feather,
Mhm.
right? And it just, and you can give me some clarity if it's all in my head or this is real. It feels like investors are always slow to lower, waiting to see how everything plays out, and they're quick to protect themselves. And that's, a lot of times when I'm talking to clients, I give them that advice. I'm like, look, if you have 30, 45, 60 days, there's a good chance if things work out, it'll take time to recover. But things can move quickly in reverse.
Yes. And I can never resist, agree with you, and I'll see you and raise you because I can never resist bringing up behavioral finance here too.
Yeah.
Which is that, again, when we put things into the client perspective, into the borrower's perspective, and we're all humans, right? It turns out as humans, we are very, very risk averse. And if things get a little bit better, if we make a little money, we say, oh, good, that's awesome. I made a little bit of money. But if things get worse, we carry that emotionally much, much more than we carry a comparably sized gain. It's about 3 times more, as a matter of fact. So the bigger picture point, and this is certainly germane as we think about things like locking or floating alone,
Mm-hmm.
is that yes, if things get a little bit better, congratulations, you get to brag to your friends. But if things get a little bit worse, and perhaps they get materially worse, right? Individuals carry that a lot stronger, a lot more. You just sit around thinking, man, I'm a dummy. Like, what was I thinking? I could have had this, right? And so on. Whereas the flip side isn't always the case. So it's important to recognize, not just the historical context and so on, but also how we react to it as humans.
What I was doing, when I'm talking to clients, I give the analogy of like blackjack or gambling. I was
Yeah.
like, if you gamble, like if you're up $500 in blackjack, are you going to walk away? Or are you going to keep playing?
Yeah.
Right? Like and some people are like, I don't gamble this. It's like, well, if you don't gamble, if you're risk adverse, then you more likely than
Go
not
on.
should lock, right? But
Yeah.
if you are Scott Story and you've got, 10 hands playing at once and you've got your credit line going max, 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 then yeah, then you want to keep gambling and see what happens.
That's right.
Um,
Man, Scott
and
catching strays here, Yeah.
oh, it's got to throw them out there. Um, so we talked about the lock versus floating. So let's say you do lock, and let's say the market does improve.
Hmm.
One of your favorite calls, I'm sure, is, "Hey James, can we just float this guy down? Can we just do a float down? Explain why float downs aren't as simple as they seem."
Yeah, thank you for giving me the opportunity to talk about that. No, it's 100%. So when if you take a step back and you think about the hedging proposition in general, so the borrower, yeah, has a conversation with the loan officer. They say, yes, I'd like to lock in today, and I'd like to focus on, let's say it's a purchase loan, I'd like to focus on the home inspection and, et cetera, right? Take this off the table. So the good news is that the borrower now sleeps well at night, knowing that no matter what happens, as long as they fulfill their end, right, they're locked in and rates aren't going to, it's not going to be a problem. The challenge, however, is that a lender now is on the other side of that, right? And what we do as a lender is we actually implement what's called a hedge. And by hedge, I mean we actually sell forward something so that the general idea, it's like a scale that when one increases in value, the other decreases in value. So to be very specific, let's say we have a $500,000 loan, and let's say that we've sold forward, as we'd refer to it, a mortgage-backed security. Good news is now if the market rallies 100 basis points, so it gets better night over night, right? Then the loan increases in value 100 basis points, and the hedge decreases in value 100 basis points. But that's okay because our goal here is to make money no matter what happens in the market.
Mm-hmm.
The opposite is the case too, right? Market sells off. Okay, the loan's a little less profitable, but don't worry about it because the hedge that is, has actually made money. The goal for a lender is to be risk neutral no matter what happens. Okay,
Sure.
well, to your point, what ultimately happens then is market improves, market improves, market improves. And you pause and you say, yep, I get it, James, but don't worry, we're hedged, everything works out. Except now we get the phone call that says the borrower once saw that the market got a little better too. So instead of a 6%, they want a 5 3/4, or they're going to walk. Well, the lender now has this really unsavory decision. And the lender, let's say it's the secondary guy in this case, they can say yes or they can say no. Now, if they say yes, okay, good news. The loan's going to close, we hope. But the bad news is that instead of having a profit margin of, say, 200 basis points on the loan, now we only have a profit margin of 100 basis points on that loan. And we might be losing money to close the deal, right?
Mm-hmm.
Or alternatively, the case might be the case that we say, no, we can't do anything, best of luck, borrower. Okay, fine. But remember, we actually did sell forward something. We actually executed a trade to protect that interest rate, right? So I can't very well, the lender can't very well call that broker dealer and say, hey, I know I sold you something. I know we have a legal contract here. I know I did that trade, but can we just adjust it because the borrower
Yeah.
wants a better term, right? So it's ultimately the case that because we are actually trading on behalf of the borrower, we're actually performing an action. Yes, we can close the deal, but ultimately we end up losing money either way.
So I'm going to ask a follow-up question, which I'm sure you've received too. Well, can't we just like switch investors? Or can't we just like cancel a lock or do a new one? How's that work?
Yeah, so the answer to that would be like, I mean, theoretically, in two things. The first is if the loan's already been approved with an investor, then the contract actually stipulates that you can't. But the second thing is, you could probably do it and you could probably get away with it once. You could probably get away with it twice, right? But it turns out the investors are tracking these different things too. And they'll start to observe that ABC Mortgage Company has this funny way of always their fallout starts to move a little bit only when this happens, right? And so, notwithstanding the fact that they'll observe that and eventually have some conversations with you, what will they do? The same thing that we would do is worsen their pricing, right? So, yes, you could do that, on the margins, perhaps ignoring the kind of contractual terms. But
Sure.
ultimately, what's going to happen is everyone's base pricing is going to get worse as a result.
That's very helpful because obviously, the pull through is something they track, and it really does affect everything. I remember, Steve would always talk about, we have some of the greatest pull through, all this stuff, because then that leads to your pricing. They see you as a
Yes.
valuable partner. It makes sense. But yeah, as a loan officer, we're just like, how can we, maneuver this? How can we do this? Oh, this guy at this company says they always do this. It's like, all right, well, maybe they got an exception this time or that time, but that's not a long term strategy.
Yeah, that's what makes you a good loan officer, right? Try to get everything you can to get that deal over the finish line.
You got to. You got to. Okay, so we've talked about secondary a lot today. What is one of the misconceptions that you feel that loan officers have about secondary?
Ooh,
Right?
good question. Um, I would give you two. I'll give you two.
Okay.
Actually. They're probably related, but I'll go with two. The first is that secondary as a profession, a little bit less so these days, but historically speaking, has always had kind of a reputation of being, the quote unquote the wizard behind the curtain. I don't really know what that guy does, but he seems kind of
Yeah,
smart, but he seems like he's doing
sure.
a good job. What secondary does is very niche, but it's not all that complex. It's a fairly simple hedging strategy to protect the company's profit margin. It's trying to find the right products and programs for the lender's unique market. It's selling loans to third-party investors, hopefully at the highest price. And like anything, there's nuance and complexity to it, but it's not nearly as complex as people think. So the first thing is, the idea that it's the wizard behind the curtain. I would push back on that. Um, and then the second thing, and I think they kind of go related, but the second thing that I would say is secondary, especially with loan officers, because that's how you ask the question. Because secondary is not necessarily something that everyone has expertise in or a background in, and because at a minimum, secondary is very involved in setting the profit margins and pricing out loans, there's always a misconception that secondary and production are, for lack of a better phrase, kind of adversaries, right? When you're doing it right, in my view, secondary is a means of actually helping to drive profitable production. And profitable is key, right? We have to keep the lights on too. But
Sure.
I think at the end of the day, what I would say is it's misconceptions about what's actually happening in the department and what their goal is, and that contributes to a mistrust. But when those two are better understand, I think the entire organization benefits.
Yeah, I mean, I think you've framed that very well. I remember when you got there, what was it 21? You said it first time. You were extremely helpful about advising us, helping us look through different ways on structuring loans, on different ways on different investors, and it really did change my view of secondary. And to the point of it wasn't adversarial; it was we're all on the same team here. How do
Exactly.
we, service our clients? How do we make money for the company, keep the lights on? So yeah, that's a good way to put it.
It's getting everyone rowing in the right direction. And I think the more that you can do that is through, in my view, transparency and education and conversations just like this.
There you go. Well, James, this was awesome, man. I really appreciate your time. Any parting thoughts or things you want to share for the group?
No, absolutely. I really appreciate the opportunity. Always good to collaborate. And if we did one thing today in explaining secondary a little bit more, then we've had a good day.
There you go. We need that the more you know sign coming up.
That's right.
All right, my man. Thank you so much for your time. I'm sure I'll see you soon.
You got it. Anytime.
See you. Let me just hit record.